Greetings, everybody. Welcome to Liberty Call. Today is Thursday, August 10th, 2023. Hope everybody's having a fantastical day out there. Another beautiful day here in Colorado. Got a little more clouds. I heard some thunder earlier, but looks like we might get some rain about 4 or 5 o'clock, but nothing right now. So my security detail back here, Mr. Jake the dog, is just champing at the bit to go outside and chase the ball around. We already did for a little while earlier around noon, but he can never get enough. Anyways, all right. Well, I'm glad you're here. Thank you very much. Today, we're going to cover what happened in the markets, the CPI data, some inflation, some other inflation news, and easy money is a big problem. So those are the subjects for today. If it's your first time watching Liberty Call, I'm glad you're here. Thank you very much. Please give me some thumbs up, like, share, subscribes, follows, and hit that notification bell. I would greatly appreciate it. All right, let's go ahead and jump into the numbers. Dow Jones was, it actually finished in the green. Dow Jones was up 0.15%, closed at 35,176. S&P 500 was flat at up 0.04%, closed at 4469. NASDAQ was up 0.12%, closed at 13,737. VIX was down 0.44, closed at 1589. Canada was up 1/3%. Brazil was down 1/10, and Mexico was down 0.63%. Over in Europe, Germany was up 0.91%, and UK was up 0.41%. France was up 1.52%. Netherlands was up 0.98%. Spain up 1.58%. Italy up 0.94%. Switzerland up 0.62%. And Portugal up 0.35%. Russian exchanges both in the green. MOEX up 1.59%. RTSI up 1.29%. And in Asia, the overnights, the Nikkei was up 0.87. The Australia was up 0.26. New Zealand down 0.72. In China, the Shanghai was up 0.31%. The Shenzhen Component up 0.1%. China A50 down 0.13%. DJ Shanghai up 0.27%. Hang Seng up 0.16%. And the Taiwan weighted came in down 0.04. So basically flat. All right. So that's markets for today. Actually, let me bring up my, close that and bring up my chart. We can look at what happened today. This was the Dow, opened up, let's see, it was up about 1.25%. And then by 2 p.m. Eastern time, hit the flat line, came back up, flatlined again. And let's look at the the S&P 500. It was up about the same, 1.25. Went into the red a couple different times, even here, and then just barely finished in the green. NASDAQ, same, very similar chart, was up about 1.7%. And then again, went into the negative territory around noon my time, 2 Eastern, and then finished the day fairly flat. So, all right. Well, that is everything that occurred today. So let's go ahead and get back to the news. Reset. All right, let's go to the market recap. Wall Street gives up gains as pop from July inflation data fizzles. All right, Wall Street's primary indices experienced a shift from initial gains to mostly flat trading on Thursday. The initial optimism arising from less severe than anticipated inflation data was gradually replaced by concerns about the longer-term prospects of the U.S. economy and the extent of potential growth in the stock market. The data revealed that both headline and core consumer price increased by 0.2% in July, with the annual rise reaching 3.2% for headline figure and 4.7% for core inflation. During the first hour of trading, all three major benchmarks indexes surged by over 1% as the traders speculated that the U.S. Federal Reserve might halt further monetary tightening this year and possibly start reducing interest rates in early 2024. However, market sentiments began to wane as the morning progressed. Young-Yu Ma, Chief Investment Officer at BMO Wealth Management, explained that the market's response wasn't expected, as expectations of tamer inflation had largely already been factored in. He noted that while the CPI, Consumer Price Index, data was positive, the market had already incorporated this information into its pricing. Despite the positive CPI reading, investors remain cautious about medium-term risks, including potential economic growth a potential economic growth slowdown, reduced lending by banks, and the effects of the Fed's prior rate adjustments on the economy. San Francisco Fed President Mary Daly's comments echoed this cautious sentiment, stating that although recent inflation data showed progress, more was required before she felt confident that the central bank had done enough. Separate data indicated that new claims for unemployment benefits increased to 248,000 last week, surpassing estimates of 230,000. August typically experiences lower market volumes as many investors take summer vacations, with the S&P 500 and NASDAQ Composite having gained for 5 consecutive months, primarily due to robust growth in major tech stocks. Any uptick in stock prices presents an opportunity for profit taking. Despite strong performance of large technology stocks, further gains have been curtailed during the 10-year U.S. Treasury note yield, rising above 4%. Amazon.com, Microsoft, and Apple remained steady or marginally declined. Most S&P sectors trended negatively, with industrials and real estate being among the decliners. In terms of earnings, Walt Disney's shares rose by 4.3% after surpassing Wall Street estimates for quarterly adjusted profit per share. Additionally, Alibaba USA listed shares surged 3.9% following a positive quarterly sales report attributed to improved consumer sentiment. Trade concerns heightened as President Joe Biden signed an executive order barring some new U.S. investments in China involving sensitive technology such as computer chips, while also mandating government notification for investment in other tech sectors. All right, so that is what is going on there today. All right, let's dive a little deeper into the CPI. This is a report from First Trust on the July CPI. It's authored by Brian Westbury, their chief economist. So again, just to reiterate the numbers, the CPI rose 0.2% in July, matching expectations. Year over year, it's up 3.2%. Food prices rose 0.2% in July, while energy prices rose 0.1%. The core CPI, which excludes food and energy, rose 0.2% in July, matching the consensus expectations. Core prices are up 4.7% over a year ago. Real average hourly earnings, adjusted for inflation, increased 0.3% in July and are up 1.1% in the past year. Inflation is up, 3-4% right now? That's not helping things. Real average weekly earnings are up 0.2% in the past year. All right, so what are the implications of this? He says more progress against inflation in July, but don't get overly excited. The recent surge in energy prices came too late in July to affect the monthly numbers. It will hit in August and could be enough to reverse the decline in year-over-year comparisons. Consumer prices rose 0.2% in July, matching consensus expectations, while 12-month came in at 3.2%, a huge improvement versus the 8.5 12-month change as of July of last year. Core prices, which exclude the effects of the typically volatile food and energy sectors, remained elevated, up at 3.1% and 4.1% annualized rates in the last 3 and 6 months, respectively. Rental inflation for both actual tenants and the imputed rental value of owner-occupied homes continued to run hot, up 0.5% for the month and running near or above 6% annualized rate over 3, 6, and 12-month timeframes. Meanwhile, a subset category of inflation that the Fed is closely watching, known as the supercore, which excludes food, energy, other goods, and housing. What else is there? Rose 0.2% in July and is up 4.1% over the last 12 months. Couple that with a resilient U.S. labor market, Powell and company still have plenty of reason to keep monetary policy tight in the months to come. The reason for the moderation in inflation this year is that the money supply stopped growing rapidly after surging in 20 and 21. The M2 measure of the money supply is down 3.6% versus a year ago. If this persists, and it remains to be seen whether it will, it would eventually bring inflation back down to the Fed's 2% target. For now, the Fed has gained some traction in its fight against inflation, but the battle is not over. In other news this morning, initial claims for jobs. Yeah, okay, we already got the jobs numbers, or we will cover them. All right, so that is everything from that. Interesting. Again, things are still too expensive, but who is shocked by that? All right, next up, just an article going into greater detail. U.S. inflation cooling as consumer prices rise moderately. Again, All right. U.S. consumer prices demonstrated a moderate rise in July, and increased rental costs were balanced by declining prices in goods such as motor vehicles and furniture. This trend could lead the Federal Reserve to maintain unchanged interest rates next month. The Labor Department report on Thursday also indicated a further easing of underlying inflation pressures last month. The annual increase in prices, excluding the volatile food and energy components referred to as core inflation, was the smallest in almost 2 years. This moderate inflation, combined with a cooling labor market, reinforced economists' belief in that the central bank could facilitate, quote, a soft landing for the economy after concerns about a potential recession for the past year. Sue Wong Son, a finance and economics professor at Loyola Marymount University, emphasized that significant progress has been made in curbing inflation and that a consistent trend in disinflation was apparent. I don't know if I haven't seen any prices actually receding back towards, 2019 prices. So let's not get ahead of ourselves. He suggested that the central bank should pause its campaign to control inflation and adopt a wait-and-see approach. Yep. Typical person who works in academia. They have no real life sense. The CPI increased 0.2% last month, matching June's gain. The rise in CPI was largely attributed to shelter costs, with rental costs increasing by 0.4%. The CPI's annual increase for the 12 months through July was 3.2%, following a 3% rise in June. The annual rate of CPI increase had picked up for the first time in 13 months, calculated from a lower base after prices had subsided last July following a sharp increase that had driven inflation to levels not seen in over 4 decades. Annual consumer prices had reduced from its peak of 9.1% in June of last year. The CPI's 1.9% annualized growth rate over the last 3 months was the slowest pace since June of 20, down 2.7% in June, aligning with the Fed's 2% inflation target. Economists had anticipated a 0.2% rise in CPI for the last month and a 3.3% increase on a year-on-year basis. Despite a generally positive sentiment on prices, the labor market cooling, and the current trend of disinflation, economists caution that a potential inflation pressures could arise from a spat of strikes, heat waves, and geopolitical tensions. Oh yeah, gotta wedge in that climate change into the conversation because it's BS most of the time. But anyways, the CPI report is one of 2 that will precede the Federal Reserve's policy meeting scheduled for September 19th and 20th. Financial markets predominantly expect the central bank to maintain its policy rate at this meeting. I think they're going to raise it by 0.25% personally. In a separate report, the Labor Department indicated that initial claims for state unemployment benefits had unexpectedly risen by 21,000 to 248,000 for the week ending August 5th. This exceeded economists' expectations of 230,000. The larger than expected rise was attributed to an outsized jump in filings in Ohio and the collapse of yellow trucking, which was also cited as a factor. Despite the unemployment numbers, the prevailing sentiment in the economy suggests a stabilizing environment with moderate inflation, which could signal a soft landing and sustained purchasing power for households. Again, I will see it when I believe it because the idiots running things are trying to crash the Titanic into the iceberg, in my opinion. All right, last up comes from our friends over at Mises. It's titled "Easy Money is a Much Bigger Problem Than Debt," written by Frank Shostak. All right. Debt's perceived impact on economic health, traced back to Irving Fisher's theory, suggests that elevated debt levels could set off deflation and a severe economic downturn. According to Fisher, the sequence unfolds as follows. Stage 1, debt liquidation begins due to shocks like a sudden stock market plunge. This compels distressed asset selling. And here, it's right here if you want to look at it or squint. Stage 2, debt liquidation shrinks the money stock and slows money velocity. Step 3, shrinking money stock leads to price level decline. Step 4, falling asset value versus liabilities result in net worth drop, causing bankruptcies. Stage 4, profits decrease, losses rise. Stage 6, production, trade, and employment decline. Stage 7, pessimism grows, confidence wanes. Stage 8, money hoarding slows money velocity further. And stage 9, nominal interest rate drop, but real rates rise due to falling prices. The pivotal stage, according to this narrative, is stage 2, which is because of debt liquidation, the money stock starts shrinking, and this in turn slows down money velocity of money. But does all this debt liquidation result in money stock decline? Debt liquidation backed by savings, a producer who saves part of his goods could exchange for money depositing in or lending through a bank. Lending supported by savings doesn't reduce money stock upon repayment, contrary to the narrative. Debt liquidation unbacked by securities. If banks lend without depositor consent, unbacked credit leads to money disappearance on repayment, as this money lacks proper ownership. In the free market, banks practicing unbacked lending could lead to trouble. Ludwig von Mises noted free banking might suppress banknotes. Without the central bank, banks making unbacked loans might face insolvency, as simultaneous withdrawals could expose their lack of funds. Money stock and savings pool. The decline in money stock is triggered by central banks' prior loose money policies, not debt liquidation. These policies support unbacked credit, reshuffling savings from wealth generators to non-generators, weakening economic growth. Economic growth core lies in the pool of savings, or the quote subsistence fund, and that's in quotes. Loose policies deteriorate this pool, leading to activities consuming wealth exceeding wealth-producing ones, inviting economic collapse. Banks play a vital role as intermediaries in lending savings. Debt increases due to wealth expansion indicates a prosperous economy. The challenge isn't debt size, but policies weakening wealth generation by reducing pools of savings. Lumping individual and government debt into national debt is questionable. Government isn't wealth generating and burdens the private sector. Any government debt means future private sector responsibility. Contrary to common perception, the threat isn't high debt levels, but loose monetary policies undermining savings pools and wealth generation. Thus, money stock decline preceding deflation and an economic slump is primarily due to previous loose money policies, not debt liquidation. And again, something I've been harping on for several years here, well, probably more than a decade, is that the amount of debt the country currently has and has been piling up, especially in the last 3 or 4 years. I don't know. I think it's all going to crumble down, and the states are going to have to figure out another means of, exchanging goods, as far as currency or money or whatever we're going to use in the future. So, all right. Well, that's everything I had. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.